Hi, folk. You all attending our presentation this morning that we're going to deal with the annuity options should you decide to uplift from the Rhodes Pension Fund. This presentation is not going to go into detail in regards to the structure and exactly what's going to happen at the time. This is more going to concentrate on those options that are available to you should you uplift. Who am I? My name is Roy Morgan. I work for the Financial Planning Consultant Division at Alexander Forbes and have been dealing with the Rhodes members since I joined Forbes in 1998. And I'm sure some of the folk I did consult at the times that they were going on retirement. So first of all, this is not a presentation individually to provide you with individual advice. We are a licensed provider, and this is for information only. It's not recommendations. So please, you can't take anything that gets said here today and say, well, this is exactly what applies to me, and this is the route that I'm going to follow. Some of you folk have indicated to Alexander Forbes that you would like a discussion with a consultant. We do have your names, and you will be contacted in regards to this, where a more detailed and personal consultation can be held in regards to your personal circumstances and whether, in fact, you should or should not be leaving the Rhodes Pension Fund. All right, so let's have a look at the world that you are living in at the moment. It's probably vastly different now to what it was when you did go on retirement and where you were employed. If you have a look at the most important things that we can have a look at in your post-retirement years is your retirement savings, of which a large proportion could be on the Rhodes Pension Fund, where you are currently earning a pension, and other funds that you might have, other retirement annuities, unit trusts, investments offshore, and bank investments. So your retirement savings doesn't necessarily mean your pension from Rhodes University or your retirement annuities. It could or should be your entire portfolio of all your investments to provide you with that pension. Also very important that we always say to folk is a budget. You need to know exactly what the expenses are that you are paying on a monthly basis. And I've always recommended as a suggestion to the members is to take your last 6 months of your current account statement and go through the expenses that you are actually paying so that you know what it is and what the increases are on your medical aid and on your basket of goods that you're buying from the various places that you're going to. So very important is to control those expenses. You are on the Rhodes Pension Fund at the moment, and that is a guaranteed pension, guaranteed to pay you the pension, but not guaranteed on the increases that you are receiving, which is targeted at 60% of inflation. So you would have an option to go for a guaranteed pension outside the Rhodes, or you would have the flexible pension option, which is the living annuity. I will discuss this later in the presentation. So folk, you need to look at the full retirement picture. As I said, it's not in isolation on your pension fund. It is a holistic, complete picture of all your investments to make sure that those investments are in line with your goals as a retired person. And very, very importantly, is to get the appropriate advice. You need a licensed financial advisor to have a look at the whole picture for you, to give you the advice, and it should be done at least twice, or if not annually, per year. I'd just like to show you, folk, what actually goes into providing for the advice when people go on retirement, and in your case, should you uplift or should you not uplift. just have a look at what actually happens behind the scenes to provide you with the advice. So it is a busy slide. I'm not going to touch on every single aspect, but just to give you an idea as to the complexities that are involved when giving advice on life and on living annuities. So the product type could be divided into two. One is on the living annuity section, and the other one is on the guaranteed annuity section. I'll touch more on the living annuity later, but basically this is the annuity where you choose the income that you require on an annual basis, and the percentage that you can choose as a pension is between 2.5% and 17.5% per annum. You can draw this monthly, annually, quarterly. However, at the moment, currently with the markets, the general advice to people on a living annuity is to draw no more than 5%, so that we could pay for inflation increases and provide pensions for you and your wife for the rest of your lives. The portfolio choice would be between you and your financial advisor as to whether going to the active markets, the balanced portfolios, for example, with the unit trust industry, or to choose passive portfolios, or to choose single managers, or to choose multi-managers. That would be a discussion that would be held with your financial advisor. Then moving over the slide, there is a product that's become available in South Africa for the last 10 years, where the insurance company actually underwrites you as an individual. So they look at the age, they look at your income and occupation, they look at your smoker status, they look at your medical diagnosis, and they actually underwrite you as an individual as to what type of what income you're actually going to be earning. Whereas generally, further over the slide, on the guaranteed annuities with the insurance companies, what they do is they don't underwrite individually. So for example, they'll look at all 70-year-old males retiring or uplifting now as to the type of income that they're going to pay going forward, and I will show you later what those insurance companies have a look at in order to provide with those pensions. So we have single life annuities, we have joint, and most importantly are the spouse reversions on those annuities, where you can choose actually what spouse reversion there could be. I will discuss that later. And then, folk, also importantly is that some folk like to know that the capital that's invested in the funds will be paid over to their beneficiaries, and that's with a life annuity and an annuity called the capital preservation option is available to you. The guaranteed terms I will discuss with you also have a significant effect upon. So basically, if you have a look at the slide, there's a lot that needs to be discussed between you and your financial advisor in order to make that decision. All right, so basically what I'm going to do now is just discuss briefly the pension types without going into too much detail, because that detail will then be covered by your financial advisor in regards to the type of the fixed annuity called life annuities that would actually fit you as an individual. So at the moment, you are the pension fund pays you a pension, an institution from Rhodes University. That pension was calculated on a formula whereby that was guaranteed. So that formula guaranteed you that pension. And as I said, what was not guaranteed are the increases going forward, which is targeted at 60% of inflation. And with the life annuities, there are various options that you can invest in. You can invest with profits, which means that we are relying on the profits of the particular organization to provide you with increases. You can have a fixed escalation, which is very popular. You can fix your annuity at a 5% growth, which is very nice in a way that you can then plan forward what your pension would be in 5, 10, or 15 years' time. These annuities are underwritten by the various insurance companies, and these rates change on a regular basis. I will touch on that later And then very popular in the scenario of annuities is the living annuity, where you can draw between 2.5% and 17.5%. As I've said, at the moment, a 5% drawdown is what is recommended to protect the capital going forth. And importantly, within that living annuity, there's no tax. There's no capital gains tax. There's no tax on the growth. There's no pay-as-you-earn tax on the growth. There is tax on the income that you earn, and it is very, very popular. So one has to look at why is it that the different companies quote on a different rate? How does that work? Or what is it that these companies are actually having a look at? So one of the most important factors is your age. So the underwriters have a look at the life expectancy of the annuitants. And obviously, the shorter the life expectancy, the higher. The longer the life expectancy, the lower income that you're going to earn. So age does play an important role in that. The older that you are, the higher the annuity that you would get. Marital status plays an important role, because are you quoting to provide a pension for yourself and your spouse, or is it just you? And then, very interesting now, are the interest rates and inflation rates as to how these factors affect the annuities provided by the insurance companies. So a rising interest rate, rising inflation provides a higher annuity. However, the insurance companies look down the road 10, 15, 20 years at the yield curve to see where do they do, because you need to understand that they pay you these pensions for your lifetime. They would have a look at the interest rates at what they believe they should be to come up with what they're going to be with now. And those are the actuarial results that, as well as obviously at the end of the day, what annuity you are looking to purchase. So generally, you would find the level annuities where you never receive an increase, pay cost, but then there's no protection against annuity. And those annuities would pay higher. You have a comparison between the ones and as well as the fixed annuity increases. And I will show you in the later slides as an example as to what they have a look at. So those are the factors that influence annuity rates. So the difficulty is that should you decide to uplift in June and you request a quotation or consultation with your financial advisor, and you decide on, I would like this type of annuity, and it gives you a quote. Know this, that quote is not guaranteed. This is going to have to be re-quoted after the transfer takes place, which could be between 9 and 12 months. So what that rate would be in 12 months' time, your financial advisor would not know. So it cannot be guaranteed. It could be higher, it could be less. So that is the risk that you would actually be taking on, is that actually not knowing in 12 months' time what income you would be earning from your capital. A lot of folk would like to protect their pensions, and the ways of protecting the pension is to purchase the guaranteed periods. You have a choice, 5, 10 or 15 years to guarantee the pension. You have a choice of an inflation-linked type of annuity where you can protect yourself against the inflation. That would be that the company would guarantee you inflation increases. A word of warning, at those annuities are the lowest because the company are taking on the risk of paying inflation increases. The annuity protection is to provide a pension for your spouse. And very, very importantly, is to what pension would your spouse be earning in the event of your death? At the moment, at the Rhodes pension, there's a 50% reversion to your spouse on the pre-commuted values that you would have received. You have a choice when you move across as to what reversion you would like your wife to earn on your pension, 100%, 50%, 75%. And that would directly also affect the income that you would be earning. The capital protection, there is an annuity called the capital preservation option, whereas the life company then takes a life policy on you as an individual. There's no underwriting. There's no medical underwriting on this pension at all. so that the cover that is taken on your life will provide that payment to your beneficiaries tax-free. It's also expensive. It would mean that from the annuity that you would be receiving, they're deducting the life premium, which can be expensive because of your age. The legacy principle, obviously, with the living annuity, you can nominate the beneficiaries, and in the event of your death, the capital that's remaining in the living annuity can then be transferred over to your beneficiaries. So let's have a look at the pricing issue that comes in now when you have decided on your personal circumstances that this is the type of annuity that you would like. It's a fixed annuity, it's on fixed annuities, not living annuities. So what we would typically do, and as you can see, we are not going to list the names of the companies. We don't want to do that. Please note, folks, that you will find that the rates quoted by the insurance companies, as they change, so that you will find that some companies are paying less than others, depending on when you quote. So as an example, we've done on this, what we do is that we set out the various types of annuities. So that's the level of 5%. There's your inflation linked I was talking about. The with profits at 3.5%, 4%, and 4.5%. So the level annuities would pay the highest because there's no future increases, but then there's no protection against inflation. The 5% annuity will then provide you with an income escalated by a guaranteed 5%, which, as I've said in the beginning, you can actually then plan what your annuity is going to be in going forward. The inflation linked, as I've explained to you, is the lowest income payable because it's guaranteed to pay you inflation increases. So the risks with the insurance company are higher. And then with the 3.5%, the 4%, and the 4.5% with profits, that means that in simple terms, that the insurance companies need to perform higher than the 3.5% in order to provide you with an income. So in the volatile times where things are not going so well in the markets and with the insurance companies, you would find that the increases are less versus when they're making good money and the markets are running very, very well, those portfolios are doing well, your increases could be more. But you don't know exactly what those increases are going to be because it depends on the performances of the portfolios by the investment companies. And most companies offer these. Of the 6 top companies that we deal with, they would all offer these type of annuities. Okay. The one annuity, 2 annuities that are not discussed here is the capital preservation option. That is the option where the insurance company take a life policy on your life in order to provide capital payments back in the event of your death. These annuities in front of you do not provide for that. These annuities provide for pensions to be paid to you and to your wife. And in the event of your death, after the guaranteed term, the pension and the capital falls away. With the capital preservation option, the capital gets paid to your nominated beneficiaries tax-free. This also does not apply, these graphs do not apply to the living annuities. So these are life annuities, and this is an example that your financial advisor would put before you once he's had those discussions to see what pension pays and what are the contractual terms of these pensions. So it's not necessarily which one gives you the highest. It's which one suits you as an individual going forward. The living annuity become very, very popular. And as time has gone on, we have learned that the importance of the drawdown rates on the capital of the living annuity. Very, very important. So the recommended at the moment is 5%. I remember when these annuities were launched, the folk were drawing 7%. That has now been decreased because we need to understand that we need to provide you with a pension for the rest of your life, and we need to take into account inflation. Because folk, the assets in the living annuity are invested. So they could be invested in money market, unit trusts, They could be invested in stable, moderate, balanced, aggressive unit trusts. There are various balanced portfolios, segregated funds that could be invested in. And that you need to discuss with your financial advisor as to your investment objective. What is the objective here? And very, very importantly, is risk. What risks are you prepared to take as a pensioner? For example, if you did your budget and you said to your financial advisor, I am earning X from the Rhodes Pension Fund, and I would like to earn the same, it's going to be a difficult conversation because it would mean that you're going to have to draw more than the 5%. In fact, it could be substantially more than the 5%, thereby placing risk on your capital and thereby having to take on more investment risk. So the balance between the drawdown rate and the investment risk needs to be managed. And it needs to be managed half yearly, quarterly, annually. Because, folk, we have seen dramatic turns in the investment market, what with COVID. Now inflation is increasing. They're increasing the interest rates. The interest rates have an effect upon the markets. Is that you understand that the pension living annuity asset should be there to provide you with a pension for the rest of your life and for that of your spouse. So very important. It is a popular annuity, but there are health warnings in regards to this. One of the advantages of this living annuity is that at any time you can transfer out of a living annuity back into a life annuity. So we do find the folk that are getting on in age that don't want these risks anymore are prepared to have a look at quotes on the life annuity side because they're older and the rates are higher with no risk, because the insurance companies take on that risk, not you. So that is an advantage, obviously. And obviously the advantages with the living annuities, there's no capital gains tax paid on switching between the portfolios. If you do nominate beneficiaries, there's no executor's fees. It doesn't form part of your estate. It's exempt. And the only tax that is actually levied is the income tax that you would pay on the annuity that you receive. So let's recap as to what faces you folk should you make this decision to uplift. We need to have a look at your age. The retirement age at the Rhodes University was 65 years of age. You might be 10, 15 years past that. We now need to look at the age of your spouse, if that is applicable. You need to do a budget to say, this is the necessity of the income that I require, and this is the income for comfort, which would be nice to have. Then, obviously, to have a look at your own health and the health of your spouse. If you have a terminal illness, or if your health is under serious threat, then possibly the living annuity could be an option for you. One also has to look at the legacy and the status of your dependents. Do your dependents still depend upon you? Are you still providing financial help? What happens in the event of your death and your spouse? What happens to the capital, if any, or the pension, if any? And very importantly, the tax status, not only of the annuity, but the tax status of your other investments, your fixed deposits, your unit trusts overseas. What is that tax status? How does that affect your income that you're earning on your annuity? Because it's going to have an effect. And I can see of late that the Receiver of Revenue have now sent out correspondence to taxpayers in regards to you earning your pension and an alternative income. That warning the taxpayers that you need to understand that both incomes are added together at the end of the tax year in order to calculate the tax. So although your living annuity or your annuity is being taxed, that might not be sufficient on the tax that you're going to be earning on other income that you're earning. That must be also be taken into account. And then a very tough and difficult discussion is to what is the future hold? So when dealing with retired people, There are two facets that I've dealt with over the years that are serious concerns to pensioners. And one is medical aid. The medical aid costs are exorbitant. And there again, one needs to look at the income that you're earning from your annuities and what other backup assets have you got in order to provide income to pay for these rising medical aid costs. Frail care, exceptionally expensive, very, very expensive. Change of residence, quite an emotional roller coaster ride for pensioners deciding now to sell their assets and to move into retirement homes, and looking for those retirement homes that have frail care. Personally, I'm dealing with that at the moment with a member of my family, and I can tell you I'm quite shocked to see the cost of frail care and the costs of these places that you can actually go and live in. Very, very expensive at the moment. Very, very expensive at the moment. Immigration, the cost of the immigration, the capital tax, gains tax that applies on the immigration needs to be taken into account. And folk, massive difference in moving and living overseas and living in South Africa. A huge shift. And what effect on your investments will the immigration have? So there's a lot that needs to be taken into account when sitting with your financial advisor to discuss, if I'm going to uplift, what type of pension am I going to buy? What assets do I have to supplement my pension? And will these pensions be the same as what Rhodes are paying? Probably not. Remember, the Rhodes pension was calculated on a formula. The annuities paid out by the insurance companies are not calculated on a formula. They are calculated and they are taken into account by the actuaries of those investment companies of age, as discussed with you in regards to your interest rates, inflation, whether you're married. Those aspects are taken into account. So, folk, it is a very tough and difficult decision to make when you are going to be faced with this as to whether you should be uplifting or not uplifting. So this presentation is not to discuss that aspect. I believe that a presentation will be given to you folk in the future in regards, more detail in regards to that. But there's one thing that I have seen on the ones that have phoned in, and the folk that have phoned in and have sent in their requests, you will be contacted by a financial advisor to have a discussion. The one thing that I've definitely picked up is that the income that you are earning from the Rhodes Pension Fund is higher than what you are going to get at the annuities from the insurance companies. I have yet to come across one case where they are comparable or anywhere near what the Rhodes Pension Funds are paying. So that is an aspect that you need to grasp and clearly decide that in all probability, your income might reduce by going the life annuity. If you're going to try and compete with the living annuity with your pension fund, you're going to run the risk in that the drawdown rate is going to be too high. And as discussed with you, you're going to put pressure on that capital going forward. So, folk, in a nutshell, to try and give you a simplistic overview of the annuity options that are available to you. As I've mentioned, some of you have indicated the willingness to speak to someone in regards to uplifting. There was a brochure that was sent out called Welcome Back, which I found very well done, with various decisions and tips that one needs to look at. Please have a look at that. And please contact us on the contact details that you can see in front of you. And if there are any questions, please, if you could forward those questions to us so that we could individually contact you folk to discuss the questions or the problems that you might be having going forward with this exercise. Once again, thank you very much for joining us this morning, and please take care. Thank you. Bye-bye.
Thank you so much.
Thank you so much.
Roy? We have reminded the pensioners that the next webinar will be held on the 16th of March, and the invite will be forwarded to you closer to the time. For those of you who do have questions, you are welcome to contact us. You have our details via email as well. Thank you so much.